performance obligations, right? So it is easy for me to first do the, there are two examples which I have in for this video, and I would first perform the obligations. Sorry, first let me perform the examples, which is the illustrations, and then I would explain what has been stated in this paragraph, right? So let's look at the second illustrations one, which is in your SBR book, and then I would do the workings in a way of a step that you're familiar with first, right? And then we'll come back to this. So here what we have, let's cover the let's cover this part here, the solutions, right? So if you just read, let's read the requirement. A car sell, right? A company sells a car including servicing for the 2 years for £21,000, right? So here we have a company, right? And this company, not only it's selling a car, right? So here we have, let's make this a car, right? Let me get this to look like a car, or something is going on here. Let's see. Okay, right, say this is the car. Does it look like a car? Not too sure now. Oops, sorry. Looks like a bus now. I'm just playing here. Come on, something is not going here. But imagine this is the car, right? So the company is selling the car, and not only the car, but also the car plus 2 years of servicing, right? So 2 years of servicing has also been provided. Not only the car, but 2 years of service. And this is what we have, right? So how much we have to pay to get this car and then the 2 year services is 21,000. So this 21,000 is what is known as the transaction price, right? This 21,000 is a transaction price. So the questions that we have here is that, you know, there are two performance obligations are connected to this contract. You know, there are two performance obligations. One, the company has to give you the car. When you pay the company, they have to supply the car. That is one performance obligation. Then the second performance obligation is that they have to service your car for 2 years, right? So we have two performance obligations here. So how are we going to split this income, which is the revenue that we're going to get? The transaction price is the money that we're going to be collecting it, right? So how this would be split between the two performance obligations, how revenue will be recognized in the books. That's what we are trying to find out, right? Because it has two performance obligations. And then the second paragraph, it says, sentence, it says the car is sold without servicing for $20,520, and the annual servicing is sold for $540. That means the second sentence, these are known as standalone prices. Suppose if you're going to buy a car only without any services, it will cost you $20,520. If you just only get the annual servicing, that will cost you $540. For 1 year's annual service would cost you $540. But here, this would include 2 years of annual servicing, right? So, and then the question is, how is the transaction price? So this is the transaction price, which is the revenue for us. How this transaction price will be split over different performance obligations. So what are the performance obligations? One is to supply the car. Second performance obligation is that we have to provide him service. We have to service that car for 2 years, right? 2 annual years service. Those two are the performance obligations. So how I'm going to split this 21,000 between them? That's the question. Now let's read a little bit from the paragraph here, right? So this is what we have: allocate transaction price. Here the transaction price is 21,000. How I'm going to allocate the transaction price to separate performance obligations, right? To each separate performance obligations. So here separate performance obligations are: one, supplying the car; second one is the servicing the car, right? And in proportions to standalone prices. So this transaction price need to be, this revenue, which is a transaction price, need to be allocated based on these separate performance obligations standalone prices as a percentage of the standalone prices. So that's why these standalone prices has been given, right? That's what they're saying it here. We will come back to it in a minute. Let's do this example in a way of steps, right? I have done the way that I would like to perform this question here, steps, and then I would show you the BPP solution, right? So we haven't come up to the step 5. We haven't done step 5 yet. So these are the 5 steps that you would approach IFRS 15 revenue recognitions, right? First, you here, this particular slide deals with only at perform step 4, but I'm going to show you the whole step up to step 4, right? So the first, we need to identify whether there is a contract with the customer. That's the first step that we need to find out. Is there a contract with the customer? Step 1, right? You can see here a company sells a car including a servicing for 2 years. So there is a contract between a company and the person who's going to buy, right? There will be a contract between the company and this person who's going to buy. So yes, we have there will be a contract. That's the contract here, right? A contract with a customer is the sale of a car with 2-year annual servicing. That's the first one. So the second one, what we need to know, we need to identify, the second step is such that we need to identify the performance obligations, right? We need, under the contract is to sell the car with 2-year annual servicing. So the performance obligations are what? First performance obligations, we have an obligations to supply a car, right? So the second performance obligation is what? We have an obligations to deliver annual servicing for how long? For 2 years. So these two are two distinct performance obligations that I have in the contract, right? Two distinct performance obligations. When I say distinct, this can be both separately, or this also can be both separately, right? So that's the second step. So the first step, identify the contract. Second step, what I need to do, I need to identify the performance obligations with separate performance obligations within that contract. So the third one, what I need to do, I need to find the transactions price. So let's come back, before we move on, let's come back to the main question. Why I have started doing this, because I have received 21,000, right, by selling this car with 2-year annual servicing. The problem I have, so how I'm going to register this 21,000 revenue in my books? There are two separate obligations, car and servicing. So how I'm going to split this 21,000 between car and then the servicing? That's the question here, right? So I've been asked to follow certain steps. First, I've been asked to identify whether there is a contract. Second, I've been asked to identify the separate performance obligations. So once it is done, third, I need to identify the transaction price. Here, the transaction price, I have only one transaction price, and we've been told 21,000 is what I'm going to receive. So this 21,000 is my transaction price. Basically, this is the revenue that I need to split, right? So once it is done, the next step, now I need to split this revenue, based on how? Based on the standalone prices. So I need to, before I start splitting them between the two performance obligations, I need to find the standalone prices. That's my next target now. Now I need the standalone prices, right? I need to find the standalone prices, right? Once I find the standalone prices, then I will be able to deal with it. So I need to know how much, if I'm going to buy the car, how much the standalone price of the car, right? So here, what I needed here, right? I needed here standalone price of a car, right? So here, the standalone price of a car, if we just go back to the question requirement, they have told us that if you buy only the car, it will cost you 20,520. So I have the standalone prices, apologize, right? I have the standalone price of the car as 20,520. At the same time, if I'm gonna get only the delivery, only the annual servicing, if I just only gonna get the service in my car, if I just simply go there to service my car, annual servicing, 1 year service would cost me $540, right? So, but I need the standalone prices, but this contract is for 2 years of servicing. Therefore, standalone price offers 2 year servicing. If you want to get 2 year service only, not with the car, only the services, I know 1 year service would cost me $540. Therefore, the 2 year service, the standalone price of a 2 year service would be 1,080. Now I have a total of the standalone prices, right? So what I'm expected to do now, so I need, as a next step, I need to find the percentage of these standalone prices as against its total, right? So for example, I know the standalone price of a car, 20 percentage as against its total. This is a standalone price of the car. Percentage as against its total, 21,600. So it's 95%. This standalone price is 95% of its total, and then the standalone price of service would cost 1,080. As a percentage of the total, it cost me 5%, right? It will become 5%. So these are the percentages of the standalone prices, right, of their total. So now I am ready, right, to split this revenue. This was the problem, you know. I have a revenue which is a 21,000. I need to split this between my performance obligations. How I'm going to split this? IFRS 15 is instructing me split these revenue based on the standalone prices of those performance obligations, separate performance obligations. So that's why I have found the percentage changes of the standalone prices, right? So I've got the percentage. So I know the first one, I know the total must come to 21,000, which is the revenue, right? So here the proportion of the transaction price, I have the transaction price, the proportion of the transaction price that need to be allocated, for the car would be 95% of this 21,000 would go to the car. That means out 21,000 was my total revenue, the transaction price I'm receiving, but in my books, out of that 19,950, I will record them as I'm receiving revenue for the car. This is revenue from car. Then for the servicing, right, I know 21,000 which I have total, out of which 5% would goes to the car. Right. So this is how the revenue allocations would take place, right? This is how the revenue allocations would take place. So as a continuations, right? And if we haven't done step 5 yet, I would cover this in the next video. So if you're just gonna move, let me just show you what would happen next. So now I have a revenue which I've allocated to each performance obligations, right? Now suppose say that I need to allocate them, I need to recognize them in year 1. And also I have to recognize the revenues in year 2. This would be step 5, right? This would be step 5, but I'll just show you now, right? So we know the car will be supplied in the first year. So the revenue that you're gonna get the car would belongs to the first year, right? The full revenue would become first year. But then the servicing, right? Servicing, we know 1,050 was the total servicing revenue, but out of which, because this revenue covers 2 years, and so only half would belongs to the first year, right? Only half would belongs to the first year. Then this next half would be recognized in the second year, right? This is how revenues will be recognized in the books, right? In year one, we will recognize them 9,950 for the car as a revenue, and then for servicing only 525. But year 2, there is nothing for the car, but for the servicing we recognize 525. But this is the step 5 that we were going to do, right? So what I have done, I have allocated this transaction price. The transaction price will be allocated. Let me go back here to explain this, right? See here, it says the transaction price allocated to each separate performance obligation. Let me stop. Right now, if we just come back here, the transaction price, which is the transaction price, right? this is a transaction price, is allocated to each separate performance obligations. Giving the car is a performance obligation, providing the servicing is a separate performance obligations. I have allocated them to separate performance obligation. The transaction price has been allocated to the separate performance obligations based on what? Based on the proportion of the standalone prices, based on the proportion of the standalone prices. We just go back again, and now it will make more sense, right? Let's read this. Transaction price is allocated to each separate performance obligations in proportion to the standalone selling prices, right? So this is the standalone selling prices proportion. This is the standalone selling price proportions. According to it, this transaction price has been allocated, right? So this is how the revenue recognition is done in according to IFRS 15, right? It's done through 5 steps, and I have the 5th steps is what we're gonna cover in the next video. Right now, let's move on, and I will go through this first example, right? And then once it is done, I'll come back to this. So in this video, what we have here, we have a mobile phone, right? A mobile phone company. We have a mobile phone company, and the name of the company is Delta Wave Company, right? Which gives customers a free handset. So here it's important for us to understand clearly the handset was given for free, right? Handset has been given for free, and right, this handset has been given for free. And when they sign a 2-year contract for provision of networking services. So if you just pause here and think of this contract, and of course we all have mobile contract, and so the handset here, sometimes we do get handset free, sometimes we have to pay for the handset, right? So here in this contract, if you get a 2-year phone mobile contract, the handset has been given free, right? And then what would happen? But then they have given us handset has a standalone price of $100, and then the contract is £20 per month, right? So we even though the handset, if you're just going to buy the handset separately in a shop, it would cost you $100, but in this contract, this handset has been given for free. They're not charging you any money. It's clear, you have to understand them very clearly. So now if you think of the transaction price, the revenue that a company gonna get by selling this contract, nothing gonna come for the handset, so the receipt the company gonna get would be what? $20 per month. That's the contract money which they're gonna get, times how many months? 24 months, 2-year contract, right? So 20 times 24, so $480 is what the total receipt the company gonna get. That means the transaction price in this example is the total receipt, which is 480. Why? Because there is nothing coming from the handset. So the problem that we have now, yes, we have received, right, or we will be receiving $480 worth of money through this contract, under which contract there are 2 performance obligations. First, we have to send this customer a handset, a mobile phone, and then second one, we have to deliver the mobile network servicing for 24 months. So there are 2 different performance obligations are there. So the problem now we face, how we going to allocate these £480 that we're going to receive, how we going to allocate them as revenues for each of these separate performance obligations, right? Like we did before, let's focus on, I'll come back to this book solutions. We're going to do the same approach like we did, right? So as I said, the first you need to identify whether there is, so these four that we have done, right? So the next one, which will be covered in the next video, which I would cover them, but I would touch, sorry. Right, so here we have now, right, so the first thing that you need to do, we need to identify whether there is a contract. So in this example, yes, there is a contract. The contract is what? According to IFRS 15, there is a contract here. The company selling the customer a 2-year contract services with a handset, right? That's the contract that we have here, right? So that's the contract that we have here. So here The contract with the customer is to deliver the handset with a 24 months contract of network services. So that's the contract that we are. So we are very clear there is a contract. So the second step, what we need to do within that contract, we need to identify whether there are distinct performance obligations, whether there are separately identifiable performance obligations. Yes, we do have one. We know we need to supply the handset separately. And also we know we need to provide them the network services for the 24 months. So these two are the separately identifiable performance obligations, right? That's done. Now the third step is what we need to do. We need to identify the transaction price, which is the revenue, right? So in this example, the transaction price, what we have, there is nothing that we're going to receive by giving this handset, right? So we know these are two separate performance obligations, and for the handset, we would not receive it. It was given free, even though there is a price for the standalone, it was given for free. So we're not going to get any money from there. But then we know the contract is signed for how long? For 24 months, 2-year contract. Each month, we're going to get $20. So there are 480 pounds worth of money is what we're going to receive. So 424 months, right? 24 months, so $20 per month. So this is $20 per month, right? So we know that we're going to receive $480 per month, right? So that adds up to the total of $480, right? So this is the receipt that I'm going to get. Receipt in the sense, this is my revenue that I'm going to get by selling this mobile phone contract, right? So now the question that I have, how I'm going to split this revenue, how I'm going to split this receipt, right? Transaction price between the two performance obligations, one for the handset, then the second, even though I give the handset for free, I need to separately identify, because that is also a separate performance obligations. People can buy the handset by itself, and then how I'm going to separate between the handset and then the networking. So for that, standards wants me to go and find the standalone prices and then find the percentage proportion of that standalone prices of that total. So in this example, I was told the mobile's standalone price was $100. So if you're going to buy this handset, you can buy that for $100, only the handset. So the standalone price, the next step is to find in the standalone price, right? So first, I know the handset would cost you standalone price, right? Here, the standalone price of the handset. Let me put the standalone, right? So here I have the, one second. So I have the standalone price of the handset, $100, and also I know each month would cost me $20. So the standalone price, if you're going to buy only the networking service, it will cost me $480, right? That's the contract, and $480 would cost only for the network. If I have the phone, I can only ask them to give me the network services, right? So it may cost only 480. So now what I need to do, I need to find the percentage of these standalone prices as against its total, percentage of the total. So I know the handset would cost $100 as against its total for 580. It's 17%. Right? So likewise, 480 is the standalone price of the network servicing as against its total 580. It will be 83%. So that for what I understand from here. Now I have the transaction price, and also I have the proportion percentage of the standalone prices, and this transaction price need to be split based on this proportion. That's what the standards IFRS 15 wants me to do. Now I'm going to do the revenue allocation. This is not revenue recognition. This is what I'm going to do, revenue allocation. So I know this is the revenue. I'm going to allocate them. So the proportion of the transaction price that's going to be allocated, proportion of this transaction price, which is 480, I'm going to allocate to the handset. How much I'm going to give to handset? 17% of this total I will be giving to the handset. Then 83% of this total of the transaction price I'm going to give to the network services. So this is how the revenue would be split. So this transaction price, revenue of 480, will be split, allocated, will be split between the handset 8160, and then for these 2-year servicing for network services 398.40, right? So this is how the revenue allocated. So the next step would be the step 5, which we haven't done, which I would cover instead next video, but then I can write it. Suppose if you've been asked to allocate this revenue in year 1 and for year 2, right? So year 1 revenue, how I'm going to allocate, we know once I deliver the handset, that would fall into year 1 revenue. The full handset money has to be, because we're going to give them for free, but then the revenue need to be allocated accordingly to the standalone prices. So that would fall within the year 1 revenue. But then we know this networking services, this revenue for 2 years contract, you know. So the first year I can only claim half of it, right? Only I can claim half of this would come to first year's revenue, and then this next half would fall into the second year revenue. So these are the revenue that I would recognize them in books. So this is basically the step 5 that we would do. We will write the journal entries and we will recognize them accordingly in the books, right? Continuations from step 4. Continuation from step 4. This is what we would do. So basically, to summarize this step 4, and first you need to identify the contract. Once you identify the contract, you need to make sure whether once you identify the contract, make sure that you are able to find out the transaction price, and which is the total money that you're going to receive by making this contract, and that money need to be split between the separate performance obligations, right? How we going to split them? Based on the percentage proportion of its standalone prices. So this is what being done, right? So it says where a contract contains more than one distinct obligation, a company allocates the transaction price. As I said, we allocate the transaction price if the contract has distinct performance obligation. You can separately identify them, meaning handset can be given separately, network services can be given separately. Here, car can be sold separately, servicing can be done separately. So we have distinct performance obligations. They're not dependent on each other. They're completely distinct. So when you have that, your transaction price, the revenue you're going to get, must be split between those two performance obligations based on those two performance obligations standalone prices proportion, right? That's what we have done this question. So it's a straightforward, not a difficult part, right? So the next video that I'm going to cover step 5, which is the revenue recognition, recognizing the revenue, basically this step here, right? The recognizing the revenue. So let's so I think I'll show this